we're going to dive deep into the video game penny stock GameSquare Holdings. On this chart, I've normalized all the value scores. If our AI is correct, then there is an outrageous undervaluing happening right now for GameSquare Holdings. 12,000 plus times the normalized market median. That's why I'm being called in to validate what the AI might be picking up on. I call this an annual report Let's Play, and let's dive in so that your wisdom can blossom.
This video is intended for educational purposes. Opinions made by me or the Sage Seeds AI are not investment advice.
This is probably going to be the smallest market cap company that we have ever done on the channel. A lot of that might have to do with this extreme value situation that we're looking for. The business strategy for GameSquare Holdings is a vertically integrated digital media, entertainment, and technology company. It does immediately list multiple assets, things like the gaming community network, Code Red eSports, which is an eSports team, a programmatic advertising business. And that's only about half of them. So let's keep going. And as if all those things weren't enough, in the second paragraph, Investor Relations Department reveals to us that on April 11th, 2023, the combo of Engine Gaming and Media Inc. with what was previously GameSquare eSports. Due to this being a recently merged company, they are immediately reconciling revenue. A massive $30 million. I say massive because it's 3 times more than the other two rows. This big chunk of change didn't exist at all in the 12 months prior. And so we're definitely going to have to look at that revenue source, SaaS and advertising. It's already more than half of all their total revenue. But before we leave this item 1 prepared by the Investor Relations Department for our benefit, let's also pick up this little tidbit. Management believes GameSquare is well positioned to benefit from the growth of the gaming and esports industries. Live streaming in particular is expected to reach more than 1.4 billion people by the end of 2025. That is this year. Because of that trend, GameSquare's revenue growth is expected to be driven by increasing marketing spend from giant global brands that seek exposure to and connections with live streaming audiences. The digital agency industry, which is what they call themselves, well, this industry is highly fragmented, which management believes positions GameSquare Holdings well for sustainable growth through organic efforts. And popping over to the consolidated balance sheets, because of that merger that we now know happened very recently, we really won't be able to compare too effectively between the last year and the 12 months prior. So for now, let's just focus on the latest column. The first thing I'm going to do is divide total assets by total liabilities. It doesn't have to be a perfect number, but this is between 1.4 and 1.6. For most businesses, that ratio is growth mode, but a healthy growth mode, not necessarily stretched. I am seeing a $4.5 million line of credit, which did not exist prior to the merger. Since that does make up almost 10% of all their liabilities, it's quite a significant line of credit that we might need to look at. But the truly big story, over $16 million in what is called Goodwill. And actually, we can go a step further and see that this $16 million appeared out of thin air, but previously there was no Goodwill, meaning that that last merger that created GameSquare Holdings was the first and only merger that this business has ever done. So now we're at the statement of cash flows. In my head, we have 2 things we want to look at: the line of credit that now makes up 10% of all liabilities, and the brand new, pretty big Goodwill number. In order to decide which one is more important, we're going to look through this cash flow statement to see if we can find any other hints. And it's not very difficult, actually. Multiple rows here, I think there's 6 of them. Changes in fair value and changes in provision. This tells me that we want to look at the Goodwill first, because these fair values are almost certainly talking about things that happened during the merger. The actual things going on here, I'm still not too sure what they are yet. Let's read them out just in case any of you are completionists and are going to get in the comments telling me I didn't read this otherwise. We have a change in fair value of the contingent consideration. No idea what that's referring to yet, but that's okay. A change in fair value of investment, warrant liability, an arbitration reserve, change in provision for the reclamation deposit, no idea, and change in fair value of the convertible debt carried at fair value. GameSquare Holdings explains that they only have goodwill related to intangible assets, and the 3 categories that they have created for their intangibles are software, brands, and customer relationships. All of them at minimum expected to last for 5 years. But as you can see here, in some cases, GameSquare believes that its customer relationships should be expected to last as much as 20 years. That's relatively high, especially for the video game industry. I know that because I look at many annual reports, but also Many video game studios haven't even been alive for 20 years. So where can the average video game or live streaming advertising company expect to project a customer relationship out for longer than many of these industries have even existed? Well, let's find out what reasoning they give. At a very high level, GameSquare eSports, I think it was called, one of the two previous companies, acquired the other one of the companies for $25.6 million. Immediately, it impaired $7 million of something called Frankly. This table doesn't explain what Frankly is, but we can absolutely look into that in a second. And then in this last row, there was another $2.2 million in disposal of Frankly's radio assets. And so GameSquare eSports buys Engine whatever, impairs 9.3 million. That's how we get the Goodwill number that we saw on the balance sheet. Looking a little bit lower, we get more detail about what is left after the impairments, what this 16.3 million is made up of. We see the same three categories for intangible assets that we saw in the other section. Going all the way to the right to these carrying values, and we're looking at the top table, we see that about half of the total intangible assets are in customer relationships. 1/6 or a little bit higher is in software, and everything else is in the brand name. These same numbers, but in a different perspective, in a different organization, are now listed out according to the year at which they're expected to be related to amortization expense, when they're going to show up in the income statement in the next couple of years. Well, my eye is going to the fact that while it's consistently decreasing, this last row thereafter at 7.2, almost $7.3 million is a really big chunk. I think it's more than 40% of the total expected amortization expense from this is being estimated to happen in 2029 or thereafter. At this point, I'm going to put together the fact that most of the carrying value, half of it, is in customer relationships. And we saw a little bit ago that customer relationships are the most aggressively amortized. Remember that GameSquare said that it can expect some customer relationships to last as long as 20 years. All of these little tidbits are actually describing the same thing, which is that GameSquare is really setting itself up to need those customer relationships to last for 20 years. Otherwise, this estimate will be off, this estimate will be off, all of these estimates will be off and just lead to heightened expenses that they're not expecting in the future. That is why I've now gone deep into the notes of the Goodwill calculations. We're here in sub-point 3, intangible assets, customer relationships. The full explanation is that the fair value of customer relationships was determined based on the relief from royalty method under the income approach. This is a special calculation that is suggested by accounting law. I actually think, although don't quote me on this, that it's not necessarily recommended by IFRS, International Reporting Standards, but it is perfectly allowed in US General Accounting Principles, US GAAP. The customer relationships were valued using level 3 inputs, which consisted of the following key inputs. And it looks like there's going to be 4 key inputs here. Revenue projections, that is the most straightforward. Just use what the acquired company had already. Number 2, attrition rates of 5, 7.5, and 15%. That's GameSquare saying that the company they acquired had 3 categories of customer relationships. One of those categories was going to lose 5% of its customers every year after the merger, and then so on and so forth, up to one category losing 15% of its customers every year. The third type of input are tax rates. These are pretty straightforward, although interesting to note that they assume a slightly increasing tax rate, which would be a little hint that they expect to be actually making more money in a couple years, which will then naturally raise their tax rate. And then here's an interesting one, a discount rate of 12.5, 13, and 13.5%. Now, looking at these discount rates, which are, in my opinion, the most important part of this whole model, but what we have to realize is that the higher the discount rate is, the more aggressive the management is going to switch off these assumptions. And that's a super important point to understand before we keep going. Some of you might be like, okay, I get it, move on, but please bear with me while I explain this again. Switching off the assumptions means that something was switched on before it was switched off. Right now, the management of GameSquare Holdings, it's expecting that it's going to receive revenue every single year according to this model, and that it's going to pay expenses every single year according to this model. managing these three types of customers are three different projects. If during the course of any of these projects, the discount rate that actually occurs, not the numbers that we're seeing here as assumptions, but the actual numbers that they can track, if those actual numbers are significantly below these discount rates, then management can say, that's enough, the project is underperforming, the project is failing, let's switch it off. At that point, they will take an impairment charge, which won't come out of nowhere. It will be related to that schedule of costs and income that we saw earlier. But it'll take an impairment charge and then reuse the resources that these three projects were taking up in a way that will be doing at least as much as this 12.5, 13, and 13.5%. When used this way, rates are sometimes referred to as hurdle rates. And bringing it back to our value validation effort, well, these customer relationships are the essence. If these projects were low quality projects, then all of the growth story would have a weak foundation. But luckily, we're seeing that these are actually reasonably solid. I'm not going to say they're amazing, but they're reasonably solid. Why? Well, because if these attrition rates had been really small, say that they were assuming, attrition of 1%, 1%, 1%. Well, if the actual number turned out to be 2%, which could easily happen, the difference between 1 and 2% is kind of not that big. Well, if they had made these really small numbers, they could have easily broken the project, which would put them in a position where they have to figure out a new project or else get into serious trouble. Here, they're expecting attrition rates of 5, 7.5, and 15%. These are kind of reasonable, and even if the number ends up being 20% or 18% or something like that, it's not going to be the end of the world. They should be able to handle that a lot better than if they had been having way more relaxed assumptions. And it's the same thing with the discount rates. These discount rates are thankfully quite high. What we have here are pretty decent margins of error. And again, this customer relationships, it doesn't look at the way that it's just kind of in the middle of the report like this. But these assumptions are really becoming the backbone of most of their balance sheet right now. So here's that balance sheet again. First thing out of the way, this $16.3 million, which didn't exist at all a year prior. Well, this is what's keeping their assets nice and high to allow them to have all these other growth plans. And we just dove deep until we got at the very core of it. Three types of customer relationships. Lowest expectation for those customer relationships is that they will be returning 12.5% every year. Those seem like decent assumptions to build a business off of.
It's been really fun to work with the Sage Seeds artificial intelligence output to make this video. Please like and subscribe.
Let's now look at the second thing that we noticed, which was this quite significant line of credit. Well, these two paragraphs explain the entire thing, I believe. GameSquare Holdings received a $10 million line of credit from a company called SLR Digital Finance. They will be able to use this $10 million like a credit card, and they are pre-approved to use it until September 14th, 2026, which would be a 3-year period. The interest is capped at a minimum of 9.5 per year, which is kind of not that bad, to be honest, for a small company. But that is the minimum. Some of the time it will be equal to the prime rate plus 8%. By the end of the year, in just 3 months or so, 3.5 months, they had used 4.5 of that 10 million, which is the number we see on the balance sheet. And so now let's go to the income statement. I think this is the first we're looking at the income statement, a little bit late in the game on this one. But ignore most of this, lots of numbers and words and blah, blah, blah. The line of credit is impacting just this one row, the interest expense. And it was a $200,000 impact in just 3 months. We can see that the total interest expense, which is the aggregate number here, was $700,000. Meaning that something like 27-ish% of all of its interest expense was just made up by that one line of credit being active for only 3 months. What that tells me is that we should absolutely expect this interest expense to continue rising in the near term. That new credit card they have, line of credit, whatever you want to call it, is going to make this number increase. I wouldn't be surprised to see this go over $1 million very, very soon. I mean, literally in the next column. But we are talking about hundreds of thousands, maybe $1 million or $2 million of total expense. When on an annualized basis, the operating expenses are north of 40 million, almost 45 million. And so it's not that bad. This company is starting to borrow money at another level than what it has done previously, but with a pretty good interest rate, to be honest, and a very reasonable cap on its new credit card. The line of credit issue does not seem to be anything to worry about. So this takes us way back to the very beginning of the video. I'm looking at this report because the Sage Seeds AI is identifying it as a crazy high value score. One of the highest, although not the highest, of the available universe of stocks right now. And so we have very clearly a growth company that believes it's the right time to do a big growth push because of this core group of customer relationships that it believes will perform well enough to support its growth initiatives. And also, it's got a brand new credit card. Both those things do line up with a value story. They're going to explain the growth story, I'm almost sure, and they definitely do right away. The combination of Engine Gaming's best-in-class technology assets with GameSquare's award-winning agency and creative capabilities allows GameSquare Holdings to now offer unparalleled insight into consumer behaviors, measuring and optimizing advertising campaigns towards customer acquisition goals in real time. And let's now do the fun part of looking at some of the brands that they're presenting. First up is Zoned. Zoned Gaming is a marketing agency, everything in the constantly changing world of gaming and esports. Second, we have Code Red. We heard that name before. Code Red is an authentic esports media agency. Since 2003, Code Red has produced major esports events. That's how I know of them. I'm aware that they're an esports team. And it looks like the infrastructure around the esports team, according to management, has managed countless marketing campaigns so far. Number 3, we have GCN. That stood for something, but I don't really remember what. GCN is a media group. So they have the marketing agency, the talent for the gaming world, for the esports world. And now they have people with the actual cameras, the reporters, the actual media group. They have a bit of wonky formatting here, but number 4 is actually right here, 4Frame Studios. 4Frame Studio is actually a more specific media studio. So they're creating presumably TV and or movies or things adjacent to that for gamers and youth audiences. Fifth, we have Mission Supply. Not just gaming, not just esports, but now Mission Supply is also bringing in fashion design, filling a need for fans seeking high-quality merchandise that represents their favorite esports teams, organizations, and youth-focused brands. Continuing on, number 6, we have Complexity Gaming. This is another one that I've heard about. Complexity Gaming is one of North America's longest-standing esports organizations. Here they put their resume over a 20-year history. Complexity's esports teams have won more than 140 championships and nearly 30 game titles. I had no idea Complexity actually belonged to a little mini conglomerate here. Continuing, we have the Frankly brand, and luckily I'm seeing the end now, thank God. Starting to worry as we just go on and on. But we have the Frankly brand, which we heard about briefly earlier. Frankly's main product is an online video platform with native apps for iOS, Android, Apple TV, Fire TV, and Roku. And so I'm starting to get why management is so proud of their vertical integration. We've got the movie studio, we have the news network, we have many esports teams. They're being combined now with an actual app infrastructure. Most of their revenue is coming from, at the top here, the advertising that happens on all of these things. And we still have 2 more brands left. Let's look at them now. Sidekick is an influencer marketing platform. It allows large companies and marketers to use data science to discover influencers with demographic and content filtering. But you can actually contact and hire the influencers directly on the Sidekick app. And then finally, Stream Hatchet. Stream Hatchet is their data analytics for the live streaming industry. They already have 7 years of historical data, which, 7 years is not that much for general data science, but for live streaming, 7 years is probably going to be up there as one of the largest data sets that exists. And they have full ownership of that historical data, I'm assuming, if they've included it here. And so together, this group of brands showing us the skeleton of what management thinks they have here, what the Sage Seeds AI seems to believe is outrageously undervalued by the market right now. Keep in mind that the price does fluctuate daily, so every time I say that, please do your due diligence on your own. This is a high-profile penny stock, very much a penny stock, and seen as a penny stock. Definitely surprising to see such a complete growth strategy. I mean, this growth strategy impresses more than growth strategies that many huge, recognizable companies put together. I don't like to trash talk that often, But if you haven't seen my video on Intel, I basically shamed Intel for claiming they had a growth strategy and then it being essentially zero information as to what that growth strategy was, even though they were talking about it all over the place in the annual report. Well, this is what a really high quality growth strategy should look like, in my opinion. I know exactly what the vertical integration they're referring to is. At the top of the funnel, they're making most of their money off of advertising. But they have multiple in-house sources of content that supposedly is in demand, as well as certain platforms to actually integrate directly into the workflow of influencers and marketers. I mean, it's striking me as quite smart, but what do I know? The Sage Seeds AI thinks that this is an outrageously undervalued penny stock. The Nasdaq lists this as a video game company, only for me to realize while looking through this that they're not making video games at all. No, they own gaming talent, eSports teams, many eSports teams. And they're surrounding these eSports teams, the Complexity Group, as well as the Code Red gaming team, which for some reason is separate. I don't know, maybe someone in the comments can explain why those are separate. But it's surrounding these eSports teams with the infrastructure to essentially define what media and advertising is going to look like for very young leaning millennials, I guess, but mostly Gen Z, Gen Alpha, and Gen Beta even if the current trends maintain themselves. You can look at our Warner Brothers, Paramount, and Disney videos. We have an entertainment playlist on the channel already. This one's definitely going in there. This merger that happened in late 2023 is seemingly injecting life into the business and growth strategy. I have no idea what the future holds. Of course, none of us do. But as I'm validating the value here, I gotta say that I'm not finding anything that makes me straight up reject what the Sage Seeds AI was suggesting. A multiple of more than 12,000 times the market median still strikes me as a little bit crazy, but this company does not even break the top 5. There might be value in GameSquare Holdings.